These three stocks are trading near 52-week lows, but not because they're bad businesses. Far from it. Most investors are reacting to noise, not numbers, and ignoring an opportunity to get in on them at a great price. So let's see if these three are really the most undervalued. As I always say, 52-week lows are a great place to start checking for value opportunities. Now, before you get too excited, let's make sure we're very clear on something. A stock going down, especially being near a 52-week low, does not make it a buy. That's like walking to a store and thinking that everything on the clearance rack is a steal. Sometimes it's just junk for a reason. But when Main Street overreacts, which it loves to do, you can get mispricings. Stocks fall out of favor, people panic, some headline screams doom. Now keep in mind, some companies deserve the beating. Maybe there's fraud. Things like United Health recently. Maybe there's bad management. Or maybe there's a collapsing business model. But sometimes the market's just being dramatic. Stock number one, PayPal. Guys, this is the company that has changed an entire sector for over 20 years. The idea of sending money over the internet 25 years ago was insane. Guess what? They did it. And they made it ultra safe and extremely easy to do. Now, why are people hating on PayPal? Well, let's go check this out, and you'll probably see very quickly. Here's the 10-year chart for PayPal. Look at that bad boy. All-time high, almost $300. Actually, I think it was $300. Falling as low as $50-some per share recently. Now, even though PayPal isn't really close, it's about 20% from its 52-week low, look at this volatility over the last 6 months. Look at this. We were at $90 a share, all the way down to 55, back up to 80, now down to... This is all over the board, and that's why it's making my list. In addition to the fact that it was about $300 a share at its peak. Now, let's go look at some fundamentals here that I love. One thing that I love about PayPal, their cash flow is growing. Even though people have said lately to me, the company is dead. All right, well, the last 5 years, they averaged $5 billion in cash flow, and last year was $5.29 billion. Okay, not something to write home about, but it's growth. That's what I also like. Their net income is lower than their free cash flow. That's hard to find out there. So people are going to focus on their net income number, not the lifeblood of the business, which is their free cash flow. There is a difference between them. And guys, if you're new to investing, I know this can sound overwhelming, and a few things will sound overwhelming here, but trust me when I say, these videos are made for everybody from beginners to more advanced, and the more you watch, the better you'll understand of this. I'm here to simplify this as much as possible. Guys, because of accounting rules and IRS rules, net income and free cash flow can differ at times. The value investor loves it when free cash flow is bigger than net income because everyone focuses on this, and this is the easier number to manipulate. So usually what you find companies doing, like Enron, is net income is very high, free cash flow is very, very low. That's a red flag, not here. Another thing, growing returns on capital. What does this mean? They're getting more and more return as time goes on the money they put into the business. This is a sign of a great business. This is a sign of a premium business. So when you see this happening, you got to pay attention to that. Look at this. This dying business was growing 7% a year for the last 3 years, 11% a year for the last 5 years, and 14% a year for the last 10 years. Yes, its growth is declining. The growth rate is declining, but the company is not declining. There is a huge difference there. Now, this is an 8-pillar thriller, guys. Everything here is a check mark. And I love that the 5-year price of free cash flow is 13.5. That means its current free cash flow is 12.8. They're buying back shares. This is what I love, guys. Nothing excites me more, and I hope this happens in the next bear market, than when companies use their cash flow to buy back cheap shares. What they're saying is, we believe in our company, we believe in our investors, and we want to give our investors more of the company. So as an example, to those of you who are new, if a company has 10 shares outstanding and you own one, you own 10% of the business. If they buy back 2 shares, you still own 1 share. But now all the revenue, profit, free cash flow is divided up amongst 8 shares. So now you own 12.5% of the business. You did nothing and the company rewarded you. I love that, but it's only good if the stock is selling cheap. That's really important here. They're growing their revenue, cash flow, everything is a check mark here, which I love. Now, let's see what analysts think about this company. This quote-unquote dying company, analysts think are going to grow its profit, earnings per share, double digits every year for the next 4 or 5 years. 11%, 11%, 13.5, 10.5, 16.5. Guys, if you believe this is a premium company and you believe these analysts, and let's say in 2029, the stock makes $8.43, you multiply it by earnings multiple of 20, you're talking about $170 stock. Not bad. The question is, can they implement that? Let's look at revenue growth. Not huge, 3%, 6%, 7%, 7%, 5%. But when you make more money on every dollar that's brought in, when you make a high amount like PayPal here, you can add a lot to the bottom line. Now, this is all great and dandy, but the question becomes, what is the right price to pay? And instead of sitting there and guessing and just assigning a multiple to last year, guys, assigning a multiple to 1 year's number isn't going to do anything for you, because at the end of the day, it values two businesses the exact same, even if one can grow at 20% and one's growing at 5%. If two companies both make $1 billion a year, but one's growing at 20% and one at 5%, should you pay the same amount of money for those companies? Absolutely not. The one that's growing 20% a year deserves a premium. If you just assign a multiple to last year's profit, you're ignoring all the future potential growth of the business. That's why we have the stock analyzer tool. It allows us to go in and put our low, middle, and high assumptions on revenue growth, profit, and free cash flow, multiple of earnings and free cash flow, and then what return do you want? It allows you to put your margin of safety in there. This is where we put the story and the numbers together. And this is exactly why this alone, and we have tons of tools in our software, this tool alone is used over 1 million times per year by our users. It is not a fluke. Before I get into that, I want to show you guys, our community members have voted on this company. We have 57 community members that have voted, and the average rating is a buy. We have a few at sell and hold, but the majority are buy or strong buy. That's their opinion. And I don't want you thinking just because it's my opinion that it's theirs, because there's one stock I own, Southwest Airlines, where I'm a buyer of it. And guess what? The community has it as a sell. That's what I love about this community. It's independent thinkers. So let's go put the numbers in a stock analyzer and see what value we'd pay for PayPal today. So guys, I did a 10-year analysis, and I did a 3, 5, and 7% revenue growth assumption here, okay? Could you argue a little bit higher? Maybe. I mean, fintech is really changing a lot. Profit margin and free cash flow margin. Guys, I'm focusing on free cash flow here because it's higher than profit margin, but over long periods of time, that profit margin will increase to the free cash flow margin. I did 16, 19, and 22%. PE and price of free cash flow 10 years from now. It's a premium business with a growing return on capital. I put 16, 19, and 22. And then finally, guys, I put in a 9% return. This is my no margin of safety, intrinsic value. What is the business worth if it were to match the market? Now keep in mind, if you're going to try to match the market, just buy an ETF. Don't go buying individual stocks. This needs to be higher than 9%. The question is how much higher, and that's individual driven. The less you understand, the more unknowns there are. You need to have a higher desired return, okay? So, very simple. We hit the analyze button. Guys, a lot of green here. I have a low price of 70 to 85, a high price of 140 to 200, a middle price of 100 to 130. Based on today's price and a discounted cash flow model, if all of my middle assumptions occur, I could make an 18% return on my money on PayPal. I own PayPal. Do not go buy a company because anybody on the internet has it. Even if what I've said today is compelling, you need to do your own research. We're here to teach a process, not to sit there and give you fish. Now, before we jump into the next one, let's take a step back for just 1 second. Most people look at a falling stock and run the other way. Not us. We lean in. We check it out because the fundamentals are strong and the price has fallen. What does that mean? It means bigger margin of safety and in some cases, more upside and less downside. Now with that in mind, let's move to a totally different beast. Let's take a look at one of my favorite high-end restaurants in the world, the place where if there was a 4th Michelin star to be given, it would be given to this place. It's called Chipotle. I love Chipotle. I love Chipotle so much that years ago, when they went through their entire E. coli scare, I remember sitting down in my bed and looking up at the heavens and I said, "Dear Lord, please give me E. coli from Chipotle because my settlement with them will be Chipotle for free for life." And I remember writing on social media, I would rather have E. coli than not have Chipotle. These are all facts. Guess what? I don't own Chipotle yet because look at this. The stock's currently at $43 a share, a new 52-week low. The high was $66 just 8 months ago. 8 months ago, it's fallen over 33%. And guess what? The fundamentals have gotten better. The company's making more money, more revenue, opening more stores. What I love about them, look at these returns on capital. 13.5% in the last 5 years, 19.6% last year. They're doing a better job as they open more and more stores of making money on the money that's invested in their business. Look at this, 5-year, what was their $10 million in acquisitions? They're probably buying the CEO's son's company and just saying, hey, get out of here. But look at these growth levels. 10-year revenue growth of 10% a year, but 3 years of 12.5%. It's actually gotten better in the last 3 years than the overall 10-year. Profit margin up 20%. Look at this, 5-year profit margin, 11.6%. Profit margin last year, 13.3%. And guys, look at this. Selling for 38 times earnings and 40 times free cash flow. So this is an example of, is it cheap enough based on its story going forward? That's what's amazing to understand. You've got to remember that even though it's selling for a high PE and high price of free cash flow, it does not tell me that it's expensive. That alone tells me nothing besides go understand. Just like if a company was selling for 7 times earnings, I need to understand why it may be selling for 7 times earnings. Now, in our community, we have 17 community members who have rated it, and the average is a sell. There's only 5.8% that have said it's a buy rating. That's interesting to me. Okay, so let's look at the 8 pillars. Guys, this is a great company. They have all check marks except for valuation level. Again, if I knew tomorrow this company is going to grow 100% a year for the next 10 years, this is cheap. If I knew tomorrow they're going to grow 1% a year for the next 10 years, this is outrageously expensive. Do you see the difference there? That's what I want you to change your mentality on. That you don't just hear one metric and think, oh, great buy. Just like a company with a high return on capital, it could be a bad company still. These are the things that I want people out there who are new to investing to understand. They're not complicated. If they sound complicated, watch a few more videos, understand, talk in the community, and people will explain it easier. But these are all ways of thinking about money and companies. If a company, you can put money into it and it grows its profit at a much higher rate than another company, that's a good thing. That's our return on capital. If a company can grow its revenue a lot faster than another company, it's a premium company. Now, let's go see what the analysts think about the growth rate for Chipotle. Well, look at this. $1.23 per share in profit this year, over doubling to $2.65 in the next 4 or 5 years. Their revenue growth, look at this, 8%, 12%, 12%, 19%, 12%. They're taking this company from $12.4 billion to $20.9 billion, essentially $21 billion in revenue. That's going to be done 2 ways. 1, increasing pricing, and 2, opening more store locations. So let's start to put those stories and the numbers together in our stock analyzer tool. So guys, again, I did a 10-year analysis, and look at this. The 10-year return on capital is 12%, 13.6 for 5 years, 19.6 for 1 year. The ROIC keeps getting better. They're getting better and better at investing the money from the business. That's an incredible, incredible business. Revenue growth, I did 5, 9, and 13% for the next 10 years. Profit margin, I did 10, 11.5, and 13%. Now, what's interesting is that 13% high, they did this year. So is this a new level of profitability for them? Or is it just a fluke year? That's what's hard to find out. But why we'll look at this. In the last 10 years, they were at 9%. Last 5 years, 11.7. So it seems like their profit is trending up. That's important to understand. Now, PE, premium business. But guys, you start at the average of 15, and for a premium business, you go up. I did 18, 22, and 26. If you said 19, 22, and 25, sure. There's no right or wrong answer. There's a way of just thinking about how much you believe in this company's staying power and its future and its possibilities. That's what's important. And finally, our 9% desired return. Now, before we get to the price, 25 years ago, guys, I was the guy chasing stocks. I was the guy following tips. I was getting caught in the hype. All I cared about was the story. I didn't understand that there were fundamentals behind that story. I quickly realized after the crash that that wasn't investing, that was gambling. And this is exactly why I wanted to create Everything Money. I wanted to give 20-year-old Paul the tools, the strategy, and the community that I never had. When you join Everything Money, you're not just getting this amazing investing software with our super famous and popular stock analyzer tool. You're getting a foundation of thinking. You're getting a way of learning to get better every single day. We integrate you into the community by showing you the courses that we have that you can watch so that we can all speak the same language. It doesn't mean we're all going to believe the same things, but we're all going to look at things in a similar way. And that's what matters. We're here to level up everyone's investing just like we have our own. And the tools and the software here supports all that. And even better, guys, coming soon, we're integrating a brokerage into the platform, but not our brokerage, your brokerage. All the top brokerage firms will be able to be on our software so that you can just log in and buy and sell stocks based on your analysis within the software. Instead of going to the software, logging in, doing your price, going to another website. Nope, it's all done right then and there. This is going to make it even easier for you to level up your investing game. And this is just one of the many chapters remaining for Everything Money. And we want serious investors to be part of it. So let me reiterate that. This is not for people that want to chase the next shiny object. If you're not ready to follow a process, if you're not ready to stick with it, if you're not ready to put in constant work. When I say constant work, I don't mean grueling. I mean just being open to learning. That's what we do when you watch videos. When you watch videos every day, that's all you're doing. That's all I'm asking you to do. If you're not like that, stay away. I don't want you here. In fact, send me an email. I'll send you money to stay out of the community. I'm just kidding. But the point is, we don't want fly-by-night people. We want people who are serious about being able to learn and understand. So if you're committed to investing the right way, you need to do one thing. Start your 7-day trial today. Click the link below. We have limited spots, and we're very confident about this. So confident that we've been talking about making it an application-only website. That doesn't mean people who are rich get in. What it means is people who are serious about learning. That could be somebody with $10, and the exact opposite could be somebody with $100 million. So if you're serious, this is your moment. So I hit the analyze button on Chipotle. Boom. I have a low price of 17, high price of 54, middle price of 30. So based on today's price and my middle assumptions, we're looking at about a 5% return. So for me, I got to be a little bit more patient. I just got to wait a little bit longer. I'm interested somewhere in the 20s. So I'm going to actually add it to my watch list at $30 a share. And the reason I'm doing it at 30 is because I want to make sure that when it hits 30, I can then go run the numbers again because the fundamentals probably got better at that point. So I want to make sure that I'm paying the right price because it might take a year or two, or it might happen in a month. We don't know. The software will keep me ready though when that does happen. Okay, so we've looked at the fintech giant PayPal. We've looked at Chipotle. Let's switch gears a little bit. This last one's a little bit different. It's retail, and not just any retail. This company has built a brand that people don't just like, they swear by it. And it's not just women, it's now men too. We're talking about lines at the door, premium pricing, and loyal customers who treat it like a lifestyle, not just some product they're buying to use today. So why is it on the 52-week low lift? Tariffs. Yep, good old macroeconomic headwinds. And when the markets panic over something temporary, that's where we get excited. Let's take a closer look at Lululemon and why this dip might just be the kind of opportunity we have waited patiently for. Guys, look at this chart for Lululemon. It's actually down 37% in the last 5 years. But keep in mind, let's look at the financials. 5 years ago, it did $4.4 billion in sales. It has now done $11 billion. 2.5 times more. It did $588 million in net income. Last year, it did $1.8 billion. 3 times more. So this company's stock is down 30% in the last 5 years, yet the business is clearly a better business. That's what I'm saying when I say you've got to watch these fundamentals. That immediately screams opportunity to me. The stock's at 204, and today it was down to 202. The low for the last 52 weeks, guys, January 30th, 6 months ago, it was its 52-week high of 423. And back in December of 2023, it hit its all-time high of 516. Guys, growing returns on capital. Look at this, 28%. Look at this revenue growth, 17% a year for the last 3 years, 22% a year for the last 5 years, 19% for the last 10 years. Profit margin, 15 to 17%. Guys, what is happening here? The only question I have for Lulu is it a permanent fixture in the retail market or is it a fad? And 56 community members have it rated as a buy right now. 56 community members. Only, what is that? Not even 6% have it rated as a strong sell or a sell. Not even 15% have it rated worse than a hold. That's incredible. Doesn't mean they're right. Doesn't mean we're right, but it means it garners attention. A stock that was $5.16 when the business was worse is now $2.04 when the business is better. I hope if you're new, you're understanding this more and you're starting to go, wait a second, there should be an opportunity there if it makes sense. That's what I want you to hear. So let's go look at the 8 pillars. Oh, 1x. And that's the 5-year price of free cash flow. But last year's free cash flow was 30% higher than the average over the last 5 years. So that's probably going to be low pretty soon. Now, keep in mind, it's down, what is that? 516 down to 200 is down 60%. And yet the price of free cash flow is still 25. That just shows you how expensive it was in the past. Okay. Now let's go see what analyst estimates are. Well, analysts seem to believe in it because it goes from $14.60 a share in profit to $25 per share in profit in the next 5 years. A growth rate of, what is that? I mean, double digits on average. And then for revenue, 10%, 6%, 7%, 6.6, 10.8, 10% revenue growth. Very solid revenue growth. So if they're right, this isn't a fad. So then we have one thing to do and one thing only. What is the stock analyzer telling us? Well, guys, I did a 10-year analysis. I did 4, 7, and 10% revenue growth. I did a profit margin of 14, 15, and 16%. I went a little bit lower on free cash flow because it has been historically a little lower, probably from their capital improvements to build out certain ways of growing the stores and all that stuff. So I'm not as worried about that. PE, I did 16, 20, and 24, and I did my 9% desired return. Guys, I hit the analyze button, and here's what I came up with. A low price of 200 to 215, high price of 475 to 508, middle price of 300 to 330, with a potential return of about 15% based on my middle assumptions. So guys, these are 3 companies that have value potential, and we've all heard about the Magnificent Seven. So what I did was, earlier this year, I picked my own personal Magnificent Seven that I owned. 7 stocks that I own that I thought were value plays to go against the real Magnificent Seven. And guess what? As of right now, I am shocked to say that mine are winning, but it's too short term to determine whether I was right or wrong. I put these picks to the test, and they're outperforming the market's biggest and most hyped names. So click the video on your screen if you want to see which 7 stocks that I picked that are beating the current Magnificent Seven and why I think they will keep winning for years to come. Thank you for your time.